After studying this module, you shall be able to gain an insight about the bond market and various types of bonds, identify factors that influence prices of bonds in the market, understand the concepts of bond valuation and its utility, analyze various theories associated with the risk and term structure of interest rates, evaluate risk in bond investment. When a person needs to borrow money, let's say to buy a home, he goes to a bank and borrows it. However, when large companies, governments and other such institutions need huge amount of money to invest in infrastructure, research and various projects, they may choose to issue bonds to the general public to meet their fund requirements. Moreover, the interest rate paid by the companies to the bondholders is often less than the interest rate charged by the banks. Borrower's money under a loan agreement requires the company to agree to a number of terms and conditions. On the other hand, issuing bonds provides greater freedom of operation to a company, which enhances its ability to do business. From the viewpoint of an investor, while making asset allocation decisions, they should not restrict their investment to stocks. Diversification is very important to reduce the overall risk of the portfolio. Greater diversification benefits can be attained by including safer investment options such as bonds in the portfolio. While stock prices and dividends are exposed to the company's performance and general stock market conditions, bonds provide an assured stream of income at fixed intervals of time. That is why bonds are also known as fixed income securities. Thus, the larger the proportion of your portfolio allocated to bonds, the lower is your portfolio's overall risk. However, the expected return on bonds is usually less than the returns on stocks. Investors approaching retirement commonly allocate much of their portfolio to bonds because they rely on it to provide them with regular income. They cannot afford to take the risk of investing in stocks. During periods of falling interest rates, investing in bonds would be a better option, as other investment alternatives could offer lower returns. Now, what is a bond? A bond represents a debt instrument issued in connection with a borrowing arrangement. It is an agreement under which an investor lends money to the bond issuer, which in turn promises to make periodic interest payments at a given coupon rate and repay the principal at a specified maturity date. A bond may be described in terms of par value. The par or face value of a bond is the amount a bondholder will receive upon maturity. Bonds may be trading at a premium, that is at more than the par value, or at discount, that is less than the par value. In the above example, the bond is trading at a premium. Coupon rate. Coupon rate is the pre-specified rate at which the issuer will pay interest to the bondholder at periodic intervals. Interest is calculated as the percentage of the face value of the bond. Maturity date. It is the date specified in the bond agreement at which the issuer has to repay the principal or par value of the bond to the bondholder. Bond duration. Bond duration is the weighted average measures of a bond life. The diverse time periods in which the bond generates cash flows are weighted according to the relative size of the present value of those flows. Maclaurin's bond duration can be calculated by the following formula. D is equals to 1 into I1 divided by I plus k to the power 1 plus 2 into I2 divided by 1 plus k to the power 2 plus 3 into I3 upon I plus k to the power 3 and so on till n into In plus mv upon 1 plus k to the power n, the whole divided by p naught, where I is the periodic coupon payment, mv is the maturity value, n is the total number of periods, k is the periodic yield, p naught is the current bond price. Or Maclaurin's duration is equals to summation t going from 1 to n, t into c divided by 1 plus y to the power t plus n into m divided by 1 plus y to the power n, and the whole divided by the current bond prices, where t is the respective time period, c is the periodic coupon payment, y is the periodic yield, n is the total number of periods, and m is the maturity value. Factors affecting bond prices. The first is level of interest rates. Bond prices are inversely related to the prevailing interest rate in the economy. The value of bonds increases when overall interest rate decreases and vice versa. For example, suppose you have purchased a 1000 bond issued by NTPC that pays 10% interest until maturity. Now, if the prevailing interest rate in the market increases to 12%, the value of your 10% bond will decrease because there are alternatives in the market that pay comparatively better than their bond. Hence, the bond will now trade at a discount value. Also, as the bond price goes down, the yield on the bond increases. On the contrary, if the prevailing interest rate falls to 8%, the value of your 10% bond will increase because the bond pays better than other alternatives. Hence, the bond will now trade at a premium. Second factor is inflation. Like interest rate, inflation is inversely proportional to the bond prices. Higher inflation rates reduces the real financial return on the bonds, that is interest. Inflation reduces the purchases power and hence the worth of the bond's coupon becomes comparatively less. For example, suppose you purchase a 10,000 bond that pays a coupon rate of 5%. This means that at the end of 1 year you will receive 500 as an interest. Assuming an inflation rate of 6%, it will cost you an additional 600 or a total of rupees 10,600 to purchase the same amount of goods you could have purchased for 10,000 a year ago. Therefore, although you earned 500, you lost 100 in purchasing power. So, in this case, the inflation went so high that it outpaced the rate of interest earned from the bond investment. Thus, we may conclude that higher the inflation, lesser will be the worth of the bond and the bond prices decreases. Third is credit rating of issuers. The higher the bond rating, the lower is the perceived default risk. If a bond issuer's credit rating improves, the value of its bond will increase because bondholders bear a lower risk of default. On the other hand, if the issuer's financial stability deteriorates, then its credit rating will go down and the value of the bond will decrease. The fall in the bond price will increase the yield on the bond. This is in fact the extra yield that investors demand for holding risky bonds rather than the risk-free bonds. The difference in yields is called credit spread. The fourth factor is bond maturity. Bonds with longer maturities will be demanded by the investors only if they offer higher yields compared to short-term bonds. This higher yield is desired to compensate investors for the higher degree of risk associated with the longer maturity bonds. Since the time horizon is long, there is more uncertainty regarding the level of interest rates. Moreover, long-term bonds are more price sensitive to the changes in interest rates. This difference between long and short-term yield is called the term premium. The fifth factor is stock market performance. Bond prices may also be influenced by the performance of equity markets. A strong equity market would attract investors to invest in relatively high yield stock. With more and more funds moving to the stock market, the demand for the bonds will decline and bond prices will fall. This in turn would push up the bond yields that would attract investors. A poorly performing equity market would drive investors away from the stock market. They will be more inclined to invest in relatively high yield bonds. As a result, the demand for bonds will go up and the bond prices will rise. Next is the bond market. Bonds are sold both on primary and secondary markets. In the primary bond market, new bonds are offered to the public for the first time, IPOs. Underwriting firms buy the bond securities from the issuers and assume the risk of selling them to investors. They act as middlemen between issuers and investors. The underwriters collect the proceeds from bond sales and passes it on to the issuer after deducting a fee which is called the underwriter discount or gross spread. When you buy a bond, you do not have to hold it until maturity. The secondary market provides a platform for the purchase or sale of previously issued and owned bonds. OTC market. The bond market is an over-the-counter market which is also known as OTC, meaning that trade takes place through securities firms rather than a stock exchange. Unlike equity, most bonds have very poor liquidity. Bonds trade infrequently and this may lead to temporary imbalances in the number of buys and sells orders that investors may place at any one time. Trading on OTC is beneficial as it provides liquidity to investors, especially looking to sell bonds before maturity. Dealers or market makers. Illiquidity in the bond market, and the resulting imbalances explain the need for the dealers or market makers who stand ready and willing to buy or sell bonds on their own account. Dealers put their own capital at risk by buying bonds even if they do not have an immediate buyer to whom they can sell the bonds. Similarly, they take an order from a client who wants to buy a particular bond and search the market for an investor who is prepared to sell the bonds. Thus, dealers provide liquidity for bond investors and are viewed as the suppliers of immediacy, the ability to trade promptly to the market. The bid-ask spread can be viewed as the price charged by dealers for supplying immediacy together with short-run price stability in the presence of short-term order imbalances. Primary dealers. Primary dealers are registered entities with the RBIs who have the license to buy government securities directly from RBI through bidding in auctions with the intention of reselling them to the other buyers. In this way, they act as market makers of the government securities and they facilitate the trading of these securities. Other functions of primary dealers in the G-Sec market include provisions of underwriting services and development of secondary debt market. Types of bonds. First is US Treasury debt securities. US Treasury securities are the bonds issued by the US Treasury to borrow money for a specified period of time to meet various government expenditures. These debt securities are considered the safest of all investments because the interest and principal payments are guaranteed by the government. Because they are free from default risk, they offer lower interest rate and hence lower yields. Treasury bills or T-bills are a type of these securities. They have a maturity of 1 year or less. They do not pay any interest. Instead, they are issued at a discount and redeemed at full face value at maturity. This difference is the reward that investors earn from investing in T-bills. Since they don't carry any coupon rate, they are also known as zero coupon bonds. They are considered to be the least risky investments available. Municipal bonds. Municipal bonds are debt securities issued by the state and the local governments and other municipalities to raise money for the public goods like construction of schools, hospitals, roadways, sewage system, etc. Government bonds. The Government of India periodically issues bonds which are called government securities or gilt-edged securities. These are medium to long-term bonds issued by RBI on behalf of the Government of India. Interest payments are made semi-annually. Since they have the backing of the government, they do not carry any default risk. Corporate bonds. Corporate bonds are the bonds issued by the private and the public companies to finance their operations and projects. Because the risk of default is higher than the government bonds, they pay higher yields to the investors. Convertible bonds. Convertible bonds give a bondholder the right to convert his bonds into the equity shares as per the conversion ratio and at a preset purchase price. This ratio specifies the number of issuers' shares the bonds can be converted into. Thus, convertible bonds combine the benefits of higher returns found in the stock along with lower risk associated with bonds. The interest rate on a convertible bond is lower than that on a non-convertible bond. Investors are willing to accept this lower interest rate because convertible bonds provide the flexibility to convert bonds into the shares and opportunities to earn more when the share prices rise. It should be noted that the investor is given an option and is not compulsorily required to convert his bonds. Usually, conversion happens after the issuer's share price rises to a price that makes it advantageous for the bondholders to convert his bonds into stock. Non-convertible bonds. Non-convertible bonds do not give any right to the bondholder to convert his corporate bonds into equity shares. Hence, it is like a conventional bond that pays periodic interest and is redeemed at maturity. Unlike convertible bonds, they are not exposed to volatility in the stock market. Callable bonds. A callable bond gives the issuer the right to redeem the bond prematurely on certain terms and conditions and at a predetermined call price. This call price is usually greater than the issue price because the issuer pays a premium when the bond is called. Usually a bond is called when the interest rate falls. Since the cost of borrowing in the market falls, bond issuers call their current bonds so that they can refinance their debt at lower interest rate. Puttable bonds. A puttable bond gives the investor the right to prematurely sell bonds back to the issuer at a predetermined price and at specified date. The put option will be exercised by the investor when the interest rate rise after the bond purchase. When the prevailing interest rate rise, current bonds become less valuable and therefore investors may be tempted to sell bonds back to the issuer and use the proceeds to lend elsewhere at a higher coupon rate. Thus, putable bonds protect the investors but at the same time expose issuers to the risk of issuing fresh bonds at higher coupon rate if the put option is exercised. That is why putable bonds trade at a higher price than straight bonds to compensate the issuer and offer lower yields to investors, that is price paid by the investor for the put option. Bond valuation. Meaning of yield. Yield can be defined as the rate of return earned from investing in a bond. However, it should not be confused with the bond's coupon rate. While a bond's coupon rate remains fixed, its yield will fluctuate with the movement in the bond's price. Higher the price of the bond, lower the yield and vice versa. There are two measures of yield. The first is current yield. The current yield relates the annual interest receivables on a bond to the current market price. It can be expressed as current yield is equals to IN divided by P naught into 100, where IN is the annual interest payment and P naught is the current market price, that is the cost of the bond. The current yield measures the annual return accruing to the bondholder who purchases the bond from the secondary market and sells it before maturity, presumably at the same price at which he bought the bond. It does not measure the entire returns accruing from bond till maturity. Hence, it does not take into consideration the capital appreciation. The current yield would be higher than the coupon rate when the bond is selling at a discount and it would be lower for a bond selling at a premium. For example, suppose you buy a bond at par with a face value of 1000 carrying 10% coupon rate. This means that you will receive 100 annually as interest. In this case, the coupon rate and yield are equal. However, if the market price of the bond is more or less than par, the current yield will be different. Now, suppose the bond is currently trading in the market at 750 and you buy the bond at this price. In this case, the coupon rate and the yield will not be the same. The bond's current yield will be equals to 100 interest per year divided by 750 cost of bond, which is equals to 0.13333. Thus, your current yield is 13.33%. Conversely, if you buy the same bond for 1250, bond's current yield will be equals to 100 interest per year divided by 1250 cost of bond, which is equals to 0.08. Thus, your current yield would be 8%, which is lower than the specified coupon rate of 10%. Yield to maturity. Yield to maturity is the most widely used measure of returns on bonds. It is defined as the compounded rate of return an investor is expected to receive from the bond purchased at the current market price and held to maturity. It is the internal rate of return earned from holding a bond till maturity. YTM is the discount rate that makes the present value of the cash inflows from the bond equals to the cash outflows for purchasing the bond. This is represented by the following equation. Bond price is equals to cash flow 1 divided by 1 plus yield to the power 1 plus cash flow 2 divided by 1 plus yield to the power 2 plus and so on till last cash flow divided by 1 plus yield to the power n. Unlike current yields, YTM takes into account both the interest payment as well as the capital gains if the bond is purchased below par or capital losses if the bond is purchased above par. YTM can be calculated as follows. MP is equals to summation where T goes from 1 to n, CI n divided by 1 plus YTM to the power 1 plus TVN divided by 1 plus YTM to the power n, where MP is the current market price, CIT is the cash inflow throughout the holding period, TVN is the terminal cash inflow at the end of the holding period, and YTM is the yield to maturity. A shortcut formula of YTM is given by YTM is equals to I plus MV minus C by N divided by MV plus C by 2, where I is the interest rate, MV is the redemption value, C is the current market price and N is the time to maturity. Utility of YTM. YTM is a very useful tool for comparing yields of bonds with different maturities and coupons. It also helps to find out whether investing in a particular bond is worthwhile or not. Investors often determine their required rate of return. After calculating the YTM of a bond, an investor can compare his required yield with the bond's YTM to decide whether to buy the bond or not. The investor will buy the bond only if the YTM exceeds his required rate. Risk structure of interest rates. The risk structure of interest rates defines the relationship between the interest rate and the annualized yields of bond at a specific point in time, holding the term to maturity constant. Bonds with the same maturity may offer different yields due to the following three characteristics. First, credit or default risk. Second, liquidity risk. And third is tax status. Let us now do them in detail. Credit risk. Default risk arises due to the possibility that the bond issuer will fail to make interest payment and repay the principal on time. Bonds with a high degree of default risk will have to offer higher yields to entice investors. Because most debt securities are exposed to this risk, it becomes important for an investor to assess the creditworthiness of corporations that issue bonds. For this purpose, investors may use bond rating issued by credit rating agencies. These agencies assess the financial status of the issuing corporation and assign rating that reflect the issuer's ability to pay off its obligations. The most popular rating agencies are Moody's Investor Service and Standard & Poor's Corporation. The following table 1 shows the bond rating by these two firms. Bonds that are rated as BAA or better by Moody's and BBB or better by S&P are called investment grade bonds. Bonds that are rated BA or better by Moody's and BB or better by S&P are called speculative grade, high yield or junk bonds. Second is liquidity. Investors prefer securities that are liquid, that is, they can be easily converted to cash without a loss in value. Thus, bonds with less liquidity will have to offer a higher interest rate to be chosen. Is it true that short-term securities are liquid and long-term securities are illiquid? The answer is that it depends on the secondary market of the long-term instrument. If it has an active secondary market, a long-term security can also have high liquidity. Third is tax status. Consider a taxable security that offers a before-tax yield of 10%. If the tax rate of the investor is 30%, then the after-tax yield will be 10%, that is 1 minus 0.3 is equals to 7%. Now suppose a tax-exempt security offers a yield of 8%. As a result, an investor in the 30% tax bracket will prefer the tax-exempt security because its yield of 8% is greater than the taxable security's after-tax yield of 7%, even though the taxable security had a higher yield in the beginning. Thus, this shows that investors are more concerned with after-tax income than before-tax income earned on securities. The next topic to be discussed is term structure of interest rates. The term structure of interest rates defines the relationship between terms to maturity and the annualized yields of bond at a specific point of time, holding other factors such as risk constant. The graphical representation of this relationship is referred to as the yield curve. Various theories have been developed in this regard, which includes first, pure expectation theory. According to this theory, an investor's expectation of future interest rates solely determine the shape of the yield curve. Consider the following two cases. Expectation of increase in interest rate. Assume that the annualized yields of short-term and long-term risk-free securities are similar, that is, the yield curve is flat. Also assume that investors, that is, lenders, expect that the interest rate will increase. As a result, they will invest in the short term so that they can soon reinvest their funds at higher yields after the interest rates increase. Similarly, if borrowers, that is issuers of securities, also expect the interest rate to increase, they will prefer to issue long-term securities to lock in the present interest rate over a long period of time. Consequently, in the short-term market for loanable funds, the supply of loanable funds will increase while its demand will decrease. Thus, the short-term interest rate will fall, causing a downward pressure on the yield of the short-term funds. Similarly, in the long-term market for loanable funds, the supply of funds will decrease while its demand will increase. Thus, the long-term interest rate will rise, causing an upward pressure on the yield of the long-term funds. The fall in the short-term interest rates and the rise of the long-term interest rate causes the original flat yield curve to pivot upward and become upward sloping. Expectations of decrease in the interest rate. If investors expect interest rates to fall, they will prefer to invest in the long-term funds rather than short-term funds so that they can lock in the present interest rate before interest rate falls. Similarly, borrowers will prefer to issue short-term securities so that they can reborrow at a lower interest rate once interest rate falls. Consequently, in the short-run market, For loanable funds, the supply of funds will decrease while its demand will increase. Thus, the short-term interest rate will rise, causing an upward pressure on the yield of short-term funds. Similarly, in the long-term market for funds, the supply of funds will increase while its demand will decrease. Thus, the long-term interest rate will fall, causing a downward pressure on the yield of long-term funds. The rise in the short-term interest rates and fall in the long-term interest rate causes the original flat yield curve to pivot downward and becomes downward sloping. Implications. This theory assumes that investors are indifferent to different security maturities along with their involved risk. Based on this assumption, a 2-year security should offer a return that is similar to the anticipated return from investing in 2 consecutive 1-year securities. This equality can be illustrated by 1 plus Ti2 to the power 2 is equals to 1 plus Ti1 into 1 plus T plus 1 R1, where Ti2 is annualized interest rate of a 2-year security today at time T. Ti1 is annualized interest rate of 1-year security today at time T. T plus 1 R1 is the anticipated 1-year interest rate next year, that is in time T plus 1. We can now determine T plus 1 R1 as follows. 1 plus T plus 1 R1 is equals to 1 plus I2 to the power 2 divided by 1 plus I1, or T plus 1 R1 is equals to 1 plus Ti2 to the power 2 divided by 1 plus Ti1 minus 1. The term T plus 1 R1 represents the market's forecast of the future interest rate. It is referred to as the forward rate. Liquidity premium theory, this is the second theory. Now, as explained in the risk structure of interest rates, investors prefer liquid securities. Short-term securities are usually considered to be more liquid. Thus, investors will be willing to hold long-term securities only if compensated with a premium. By combining the expectation theory and liquidity premium theory, the yield on a 2-year security can be determined as 1 plus Ti2 to the power 2 is equals to 1 plus Ti1 into 1 plus T plus 1 R1 plus LP2, where LP2 represents the liquidity premium on a 2-year security. Thus, the yield on a 2-year security should exceed the yield from investing in 2 consecutive 1-year securities by a liquidity premium that compensates the investor for lower degree of liquidity. The third theory is segmented markets theory. Unlike the expectation theory, the segmented market theory assumes that markets for securities of different maturities are completely segmented. According to this theory, people choose securities depending on their anticipated cash needs. If borrowers need funds for a long period of time, they will issue long-term securities. Similarly, if investors can invest funds only for a short period of time, they will invest in short-term securities. As a result, short-term interest rate will fall and long-term interest rate will rise. This will result in an upward sloping yield curve. One criticism of this theory is that it completely ignores people's expectations about future interest rates. Thus, a new theory called the preferred habitat theory has been developed, which combines the segmented market theory with pure expectations theory. Preferred habitat theory recognizes that investors and borrowers choose securities with maturities that suit their needs, but they may also be tempted to stray from their preferred maturity markets depending on their interest rate expectations. The next topic to be studied is risk in bond investments. Although bonds are considered relatively safe investment, they also expose investors to the risk like, first, interest rate risk. Interest rates tend to fluctuate over a period of time, and as a result, bond prices fluctuate. A rise in interest rate will depress the market price of outstanding bonds and vice versa. Interest rate risk is also known as market risk, is measured by the percentage change in the value of a bond in response to a given interest rate change. Second is credit risk. There is a risk that the borrower may not pay interest or the principal amount on time. Bonds which carries a higher default risk trade at a higher YTM. This means that they trade at a lower price as compared to risk-free securities. Third is inflation risk. During the periods of high inflation, it may happen that inflation increases at a much faster rate than the return on investment. In such a situation, inflation erodes the purchasing power of the investor's future cash inflows, sometimes leading to a negative rate of return. The government may increase interest rates to combat increasing inflation. This in turn would lead to lower bond prices. Fourth is reinvestment risk. If the prevailing interest rates fall, investors may have to reinvest their interest payments at the new lower interest rates. This is called reinvestment risk. This risk is greater for bonds with longer maturity and for bonds with higher interest payments. Fifth is liquidity risk. Except some popular government securities which are traded actively, most of the debt instruments have very weak liquidity. As a result, investors face difficulty in trading debt instruments. They may have to accept the quoted price which is at a discount while selling and premium when buying. However, liquidity risk is not a major concern for an investor who plans to hold the security until maturity. Summary. A bond represents a debt instrument under which an investor lends money to the bond issuer, which in turn promises to make periodic interest payments at a given coupon rate and repay the principal at a specified maturity date. Bond duration is the weighted average measure of a bond's life. There are several factors which influence bond prices. These include level of interest rates, inflation and credit rating of issuers, bond maturity and stock market performance. Bond market is an over-the-counter market, meaning that they trade through securities firms rather than a stock exchange. Bond valuation. The current yield relates the annual interest receivable on a bond to its current market price. Yield to maturity is the compounded rate of return an investor is expected to receive from a bond purchased at the current market price and held to maturity. The risk structure of interest rates defines the relationship between interest rate and the annualized yields of bonds at a specific point in time, holding the term to maturity constant. Bonds with the same maturity may offer different yields due to different credit risk, liquidity and tax status. The term structure of interest rate defines the relationship between the term to maturity and the annualized yield of bonds at a specific point in time, holding other factors such as risk constant. The graphical representation of this relationship is called the yield curve. Theories that have been developed to explain the term structure of interest rates include pure expectations theory, liquidity premium theory, and the segmented markets theory. Although bonds are considered relatively safe investment, they also expose investors to the risk like interest rate risk, credit risk, inflation risk, reinvestment risk, and liquidity risk.